Gemini. Let's get stuck in.
November the 16th, 2022. 340,000 users tried to withdraw from a product called Earn. 940 million frozen. The exchange that called itself the most regulated in America had lent customer crypto to a single company that lent it onward to a hedge fund that collapsed. The founders had sued the creator of the biggest social network for stealing their idea, settled for $65 million, bought Bitcoin early, and built the exchange to be what every other was not: regulated, trustworthy, institutional. Then 4 regulators fined them over $132 million. And then by January 2026, every user got every coin back. The only exchange in history to recover 100% from a major lending collapse. The most regulated exchange that failed, and the only one that made it right. The founders came from a specific kind of experience. They had worked on a project at university that someone else turned into one of the most valuable companies in the world. They settled the lawsuit and used the money to buy Bitcoin when almost nobody else was paying attention. By 2013, they were among the most prominent crypto investors in the country. They tried to launch the first American Bitcoin exchange-traded fund. The securities regulator rejected it in 2017. That rejection shaped their approach. If the regulator would not approve a passive Bitcoin product, the founders would build the exchange so regulated that the regulator could not question the infrastructure. So they built the exchange instead. Gemini launched in October 2015 in New York with a trust charter from the state financial regulator, not a standard license, a full fiduciary trust company charter, the same legal structure used by institutional custodians. The most rigorous regulatory framework available to a crypto exchange in America. They funded it themselves, no venture capital, no outside investors demanding returns. Their combined personal wealth provided the capital. The entire brand was built on one claim: this is the most regulated crypto exchange in the country. For years the claim held. The professional trading interface offered the lowest base fees in the market. Institutional custody with $200 million in hot wallet insurance through a major insurer, a regulated stablecoin with state approval, a credit card with the highest crypto cashback rates in the category. Then in February 2021, they launched a product that promised yield. The most regulated exchange in America was about to test what that regulation actually meant. Gemini Earn promised up to 7.5% annual yield, more than 100 times the national savings rate. Redeem at any time, no minimum balance, no fees. The marketing used the trust of the most regulated exchange to sell the product. What the fine print disclosed, but the marketing did not emphasize, was that user crypto was being lent to a single company. That company was lending it onward to a hedge fund in Singapore, to a lending platform, to a network of counterparties that would begin collapsing in sequence. In June 2022, the hedge fund collapsed after leveraged positions failed. The lending company that held the Earn funds suffered hundreds of millions in unrecoverable loans. Then another lending platform failed. Then another. Then in November, the offshore exchange that had been propping up parts of the system collapsed and billions vanished. The lending company could not meet withdrawal demands. On November the 16th, it halted all redemptions. 940 million, belonging to 340,000 Gemini Earn users, was frozen. One user had 110,000 locked. Another had over 60,000 in deposits that could not be withdrawn. The 5-business-day redemption commitment in the terms of service meant nothing once the counterparty filed for bankruptcy. One of the founders published an open letter accusing the head of the lending company's parent group of fraud. He called him the architect of the harm done to Earn users. Lawsuits followed. The public feud between the founders and the lending company's leadership became one of the most read disputes in the history of the industry. But the letters and the accusations did not unfreeze a single account. The regulators were already moving, and the cost of being the most regulated exchange was about to become very specific. The state financial regulator fined Gemini $37 million and required another $40 million to be paid into the bankruptcy estate. The securities regulator charged Gemini and the lending company with selling unregistered securities through the Earn program. The state attorney general settled for $50 million. The commodities regulator fined them $5 million for misleading statements during a futures evaluation years earlier, entirely separate from the Earn collapse. 4 regulators, over $132 million in fines and contributions. The exchange that built its brand on being the most regulated had 4 enforcement actions in 3 years. Then the recovery happened. The bankruptcy court supervised distributions, the fines funded part of it, the founders contributed, and the crypto market recovered. By May 2024, 97% of owed assets had been returned in the original cryptocurrency. By January 2026, it was 100%. Every user received every coin back. Because the market had risen significantly between the freeze and the return, the total value distributed was over $2 billion, more than double the value at the time it was frozen. No other major lending collapse in crypto history has delivered this outcome. The competitors that froze user funds at the same time returned between 35 and 80 cents on the dollar. Gemini returned everything. In June 2025, the company filed to go public. By September, it was listed at a valuation of just over $2 billion, revenue of $180 million, a loss of $58 million. Not yet profitable, 3 senior executives departed in February 2026. The exchange that survived its worst crisis is now public, still losing money and restructuring its leadership. But every earn user got made whole, and the question of what most regulated actually means was answered in the most expensive way possible. Gemini is the exchange with the lowest base fees for active traders in this series, 0% maker at the professional interface, the only exchange other than the largest competitor that serves New York. A trust charter that provides a level of regulatory standing no other platform in this comparison holds. Institutional custody with documented insurance, a credit card with the highest crypto cashback in its category, and the only exchange in the history of the industry that froze nearly $1 billion in user funds and returned every single coin. But the professional interface that offers those fees is hidden from casual users who pay significantly more through the standard one. The asset selection is the smallest in the series by a wide margin. The exchange is not yet profitable. 3 senior executives left in the same month. The commodities regulator fined them for misleading statements years before the earn collapse. And the earn collapse itself, no matter how remarkable the recovery, demonstrated that being the most regulated exchange in America did not prevent $940 million in retail funds from being locked in a single lender's bankruptcy for over a year. For an active trader in New York who uses the professional interface and does not need hundreds of altcoins, Gemini offers the lowest fees and the most rigorous regulatory standing in this series. For someone who assumes the most regulated means the most protected, the earn story is the answer to what regulated actually means when it matters. It means accountability after the failure. It does not mean immunity from the failure itself. Every choice is a trade-off. At least now you know what you're trading.